Welcome to the latest edition of Next Gen Treasury. Our aim is to deliver great content and ideas on topics that are timely and relevant. My name is Oscar Johnson. I'm the head of BMO's U.S. Treasury sales team. Every day, our coverage teams have thoughtful conversations with large and small commercial clients. Having a finger on the pulse, we often hear the challenges and triumphs that exist in the markets. Many companies are merely surviving in times of reasonable uncertainty. At the same time, many are thriving, navigating and opposing the trend of business cycles. That's why we're here today. What category do you fit in? Instinct says many on this call fit in both, thriving some months and surviving others. Our guests today are Jennifer Lee, Senior Economist at BMO, and Peter Moirano. Peter leads our liquidity optimization team within the commercial bank. Peter's team is unique in our business, and I'm glad he's joining to add perspective. Peter, please take a minute to tell us about your team.
Thank you, Oscar. Good afternoon. The liquidity optimization team is very unique in the commercial franchise in the U.S. We started back in 2019, right in the middle of the last rate cycle. The idea for the team was to provide additional value and advisory to our customers along the topic of liquidity and liquidity management. So we specialize in best practices when it comes to helping you manage your liquidity. We focus in three key areas. So number one, the infrastructure of liquidity management. This has to do with your investment policies, how you forecast your cash flow, and how you segment your cash once you understand your forecasting. The second is the environment. How are the market conditions impacting your ability to effectively manage your liquidity? And third, we specialize in tactics. This is layering in the appropriate accounts and solutions to your business to help you take advantage of the situations and opportunities when they present themselves.
That's great, Peter. What's been one key theme your team has been discussing with clients?
So, Oscar, it's really been all about the macro environment. 2023, the path for rates became finally clear. You have to remember that we've been operating under one of the most aggressive interest rate cycles in history. The current cycle began in March of 2022 and ended, the hike cycle ended in July of 2023. So that's 16 months where rates have gone from effectively zero to 500 plus basis points. We're at a 24-year high in rates, and you have to go back to 2000 to operate an environment like this. So for our clients, operating in this type of environment with this type of velocity and rate change has been challenging. There's not a lot of experience with this type of cycle, and our clients have needed to make thoughtful pivots during this event in order to take advantage of the opportunities that have presented themselves. Late last year, it became clear that the hike cycle was coming to an end, and that impacted markets, it impacted equity markets, it impacted bond markets, and created a couple of spots of opportunities for our clients to take advantage of.
Got it. And Peter, given that this environment has been more certain, have clients been able to capitalize on this?
Yeah, absolutely. I'm going to try and do my my high school Latin teacher proud here. Audentes fortuna juvat. Fortune favors the bold. So, like I said earlier, this is a very aggressive hike cycle, something we haven't seen in a very, very long time. And back in 2022, it was relatively easy to manage through that period. We were advising our clients to float like a butterfly, right? The signals were clear post-pandemic that central banks needed to kind of get back to work and lean into rate cycles. They were clearly signaling when liftoff was going to come. However, there was a bit of misdiagnosis about inflation. It was claimed to be transitory, but then as we saw, in the summer of 2022, the central bank started to get super aggressive. So aggressive that we haven't seen that type of velocity since the early 80s. Something our clients and ourselves have not had to deal with or manage through. 2023, the story was a little different. We were telling our customers, sting like a bee. When rate paths became clear and things started to settle down in the beginning of last year and throughout this summer, certain inflection points started to leak into the market and created opportunities for our clients to take advantage of. So, I'll give you an example. Between December 2022 and May 2023, there was a significant opportunity to capture yield in the 3-month CD or term market. Between 2023, June 2023 and October 2023, there was a significant opportunity to capture yield with the 6-month CD or the 6-month Treasury. From November till now, things have remained flat. All of this to say the situation has been dynamic. However, clients that were able and in a position to take advantage of these things did, and fortune definitely favored them during that period, Oscar.
Got it. Thanks, Peter. Well, if it's too soon to tell, then we need to bring in someone with perspective on the market and the macro drivers that seem to be driving those opportunities. Jennifer, what are your thoughts?
Well, first of all, but I have to tell you guys that I normally have some sort of a fancy title for my slideshow, and my latest one is called "It's Complicated," and it's not really paying homage to Avril Lavigne, and of course I'm dating myself at this point, nor is it my status on social media, but it's of course how I kind of see the landscape before us, both the economic and especially the political one. So let's just look at growth, for example, like global growth right now. We are so far looking at global economic growth that so far looks fairly resilient. We have about 2.9% penciled in for this year, about 3% penciled in for next year. And that's definitely not what we would classify as a recession. It's sort of hard to describe exactly or to pinpoint exactly what a global recession looks like or what numerically it is. But for us in global in BMO economics, we estimate it to be something in the low twos. So obviously 2.9 and 3 is not exactly recession territory. And overall, it's pretty darn good actually, just considering everything that the world has been through in terms of tighter monetary policy, as Peter was just talking about, and of course we've gone through a number of wars. Now this week we've got the IMF and the World Bank. Their spring meetings are kicking off in DC. Now, right now, it seems like the IMF is probably going to tone down their description of about the global economy before they're calling it resilient. I think they're a little bit more cautious now because what we're looking at in terms of persistent inflation. But overall, that's all as interesting as that is. It's still early in the year. And there are a lot of influencers that are out there. And I'm not talking about Dua Lipa. I'm not talking about Taylor Swift. But at the same time, I think Taylor Swift does have some impact on the U.S. economy. But of course, I'm thinking about places like China. They don't have, three things that they are no longer working off of. They don't have a massive trade surplus anymore. They no longer have a massive or a big labor force, to push things along with, and they are no longer looking at breakneck growth. So now they are struggling with a very difficult property market. And by the way, the property market accounts for the largest share of household balance sheets. So when households are seeing this big asset declining in value, and that's going to hurt their confidence, that's going to impact their need or their want to start spending, and they're not. At least they've tailed it back a little bit. And of course, that's going to hurt profits, and that's going to push China into deflation territory, which is sort of what they're at now. So they're dealing with a struggling property market. They're also dealing with very weak demographics. So here are a couple of somewhat depressing factoids for you. The birth rate is at a record low in China, and the death rate is at the highest level since 1974 or during the Cultural Revolution. And by the way, for the last 2 years in a row, China's population has actually declined. So that's just something that they're also continuing to grapple with. And at the same time, we're looking at something like global protectionism. Even though there are a lot of countries that are still obviously trading with China, they're become very wary of their policies. Basically, they're really tight grip on green technology. Now, so far, from the data that we've seen, it's been a pretty decent start to 2024. Now, whether or not they're going to meet that about 5% growth target, and I use my air quotes because that's what their official target is, I think it's a bit too soon to tell, but, I am encouraged that we have seen a decent start to the year. So China, that's one influencer. Europe is another one, and I would be the first to admit I am actually very surprised that they didn't go into a deeper recession over the past few years. Now, Mother Nature, we can give thanks to Mother Nature. She definitely had a role in this, had a couple of very warm winters, and that helped Europe build up their big storage of natural gas. Actually, at this point right now in the year, they're at their highest level on record, I believe. But it certainly doesn't help Europe that they're basically surrounded by wars and conflicts, a lot of strikes, by the way, and the temperature on the war obviously just um, rose over the course of this weekend. So that's not exactly confidence building. So therefore, we have weaker consumer spending, we have weaker just business investment. And by the way, I'm kind of jumping all over the map here, but I should also mention that um, Europe also happened to it helped Europe build up their natural gas storage because they also, not only because they secured contracts elsewhere, but because they used less. And this is why they also have slower GDP growth. So on top of all the physical conflicts, there are also a lot of trade conflicts, in particular with China, who's basically, eating Germany's lunch when it comes to the auto sector. So all that aside, if you're looking for a growth leader, you don't have to look much further than our own backyard. And we look at the US to basically lead the way this year for global growth. 2.4% is our estimate for GDP, and it's slowing only moderately next year to about 1.8%.
Great. Something positive.
Yes and no. So this is where I'm going to be doing my on the one hand, on the other hand routine. This is good and bad. Obviously, that the U.S. has been very resilient. And by the way, sometimes I think if am I using the R word too often? But I rather use the R word of resilience rather than than recession. But overall, it's the U.S. economy continues to surprise even after 525 basis points of rate hikes. And we can basically give thanks to a number of factors, but for sure, it's all the pandemic savings that consumers held on to when everyone was like locked up at home and unable to go anywhere. Still having a job, of course, but or still working. A number of Americans continue to work, so we had a lot of pandemic savings built up. And a lot of those savings have been run down, but you're still getting a lot of incomes from working, so they're sort of filling up that savings bucket somewhat. The latest payrolls report for March was like incredibly strong at 303,000. The latest February wages and salaries increase of 0.8% which was actually quite surprisingly strong. So that's certainly helping the consumer. Consumers are also a lot less impacted by a lot of these rate hikes in terms of their mortgages, by the way, just because their mortgages in the US are of 30 years in duration. And by the way, speaking of US consumer resilience, did everyone see the retail sales report? Surprisingly strong almost across the board and with upward revisions to the prior month. So that's also starting Q1 on a very strong note. So the consumers are definitely forces to be reckoned with, I think, at this point. Of course, Uncle Sam helped out a lot of fiscal stimulus. I'm thinking of the Inflation Reduction Act, the IRA, the Sciences and Chips Act. There are a few examples that have come up over the last couple of weeks with Taiwan Semiconductor securing another contract from the Chips Act. Intel as well has also benefited, and Samsung is the latest one that secured another contract to build a fabricated plant, or a fab, I think that's what they're called now, in Texas. So all these, by the way, new construction buildings of new fabs, new fabricated plants. All that is good news for the future, but it doesn't kick in right away. It takes time to get it through all the red tape. It takes time to staff all of these facilities, but this is good for the longer term. So we know that we're going to have a longer term support. And the U.S. is also getting a little bit more of cushion from all the volatility in the energy markets because the U.S. is now a net oil exporter. So that's the U.S. Now, in terms of Canada, we've actually happened to surprise a little bit on the upside as well in terms of the economy. We had a couple of very strong GDP numbers for both January and February. And February is just an estimation, but so far that's a pretty decent start to Q1, even though in Canada we continue to struggle under the weight of very high rates. And we can thank trade for that. We're benefiting from a very big exposure to the US. The US is our largest trading partner. So in terms of exports, when the US is doing well, Canada does well as well. We've got trade exposure to the global economy, and we've also seen our population boom, which is helping GDP growth. But consumers in Canada are a lot more rate sensitive than those in the US because households are struggling under higher debt than the US counterparts, and we have shorter term mortgages up here. When there's a number of mortgages that are renewing, that's going to probably hit GDP growth soon. We also have a lot less fiscal support, which is probably not a bad thing, just considering that it could have been more inflationary than what we're already seeing. So overall, still plenty of risks out there for both Canada and the U.S. But hey, all things considered, not too shabby.
So I'm thinking about or reflecting on a conversation I had last week with a client, and I heard you use the word resilience. And if I had to ask, and of course I will, what's the biggest factor behind this resilience?
So I'm going to, if I had to point to one factor, I'm going to say it's the job market. Now it's been balancing out, and I think that's a phrase that Fed Chair Powell continues to use. It's balancing out, but it's still a very tight labor market. Now the pace has obviously slowed, but businesses out there are still hiring. You know, it's some months will be stronger than others, but overall the trend is still up. Now, when we're talking about the job market, I sort of like to take a step back, sort of look back at what has happened over the last 4 years. Going back to 2020, we had millions of jobs were lost. And then 4 years later, we're all definitely older. Some of us are wiser, some of us may not be, but overall, we've had the benefit of time, right? So we've had a number of people who are taking an early retirement, sort of like a work-life balance. The pandemic has taught us, have taught some people, what is sometimes more important than other things. And do you need to be working? I'm going to exaggerate here. Like you still need to be working like a million hours a week. So we've seen a lot or a number of people take an early retirement. We're seeing normal retirement kick in again because of 4 years have passed. A lot of people are now hitting for this year the magic age of 65. Now, this is also going to be a very interesting year, by the way, especially in the US. We're going to see a record 4.1 million American boomers who are going to reach that magic age of 65 this year. And then there are a couple of names that have been thrown about that we're calling this thing. They're calling it the peak 65, or they're also calling it the silver tsunami. So whatever the phrase is, a lot of people are going to be hitting 65 this year and over the next few years, but this is probably going to be one of the crucial years. So eventually, we are going to start seeing a smaller labor force. Now, on top of that, you've already seen some industries who are facing a shortage. This is before, during, and even after the pandemic. And we're still seeing that again play out. Truck drivers, I remember that was something that kicked in like way before the pandemic hit. And I remember reading about this, how a lot of the truck drivers out there now are all older. And a lot of the younger people now are just not willing to spend, I don't know, like 2 weeks out on the open road with their big rigs, spending time away from the family. It's a very difficult life, right? So a lot of people are not willing to make that trade-off, I guess, to become a truck driver. So we're seeing a lot of shortages still of truck drivers. The sectors that had the hardest, I think, or two of the sectors that were hit the hardest during the pandemic: educators or education sector, and of course the health sector. So we saw a lot of doctors and nurses, teachers, step away from their roles. So I think there are still some shortages there. Other shortages I've been reading about, like lawyers and accountants. Not sure what's up with that, but that's apparently there are shortages of those as well. And of course, construction workers, and that's also hurting the housing sector. So I think because of this still evidence of shortages, and of course the memory of how hard it was to bring people back into the workforce, to hire people, I think this is why we continue to see some hoarding out there. And we're also still seeing a lower participation rate than before the pandemic as well. So this is where immigration is going to kick in and have a more of a bigger say. Having more qualified immigrants coming in to fill these roles. And by the way, I should also add, it's not just about getting older as well. There are other lifestyle changes. Some people just, for example, you're hearing about people who do not want to work somewhere that does not offer remote work as an option. Some people have changed their lifestyle. You hear about women who are finding it hard to find more affordable childcare. So all of these things, or upgrading your skills, for example, to get back into the workforce. A lot of these factors are playing on the job market itself, and this is why I think the job market is going to remain tight for at least a while. And by the way, I should also mention, just demographically, it's not going in the right way either. You've got the working age population. This is like 25 to 54. Globally, sort of been flattening out or declining somewhat. You've got China, for example. Apparently, I've been reading about how China's working age population peaked back in 2011. Japan peaked way back in 1995. And on top of this, you've got global fertility rates that are on the decline. So the total fertility rate on average should be 2.1. And this is just to keep the population stable. So we're talking about average births per woman. So that's been declining. So, but apparently, but by 2050, you're going to see, for example, instead of 2.1 in Western Europe, you're going to have a number of about 1.4 for the fertility rate in Western Europe, by the way. In China, it's going to be 1.1, and right now it's like 1.2. South Korea is quite interesting. They're looking for a total fertility rate of 0.82, which is incredibly low. And some companies, for example, have been throwing out all these financial incentives to have certain people in their company boost that birth rate, and they're offering $75,000 to have a baby. Maybe not the best reason to have a kid, but hey, I guess it's like whatever works at this point. But overall, again, I still think that the job market is balancing out right now, but I think longer term it's still going to be tight because of all these factors.
Got it. Okay, thanks, Jennifer. So inflation is a hot topic. Last year, we saw some better CPI numbers here in the US. Then January and February, they were higher. Where do you see inflation going? Are we ever going to get back down to the target?
Okay, this is when I get a little bit hot under the collar here. So yes, right now we've had January, February, and now March of very hot or hotter than expected inflation numbers, particularly in the US. So I think the short answer is, yes, at some point. I say that kind of, with a little bit of question mark. Yes, we're probably going to hit that magic, or maybe not magic, that goal of 2%. It's the question, of course, is how long it's going to take to get there. So, again, taking a step back, we have come a long way. We are no longer at like 8-9% peak or multi-decade high inflation for both Canada and US. We've come a long way. Canada's now about 3%. US is still very sticky around the 3.5% mark. So I would like to call this, low-hanging fruit from getting, and Fed Chair Powell also said the same thing. I can't remember who took it from who, but getting from those highs down to where we are right now was almost like the easy part, sort of. And now we are, getting from like 3.5% down to 2%. It's definitely the much more challenging role. And by the way, it's not like the old days when all we cared about was headline and core. It's now we're looking at things like goods, and remember, if everyone remembers back during the pandemic when goods prices surged because of the shortage, that's come down a lot. So we're no longer worried about goods prices, not as much, obviously. So now it's more about services. This is where things are very sticky, and it's not just a U.S. Canada phenomenon. This is globally. Other countries too, like the UK and the Euro area are keeping a very, very close eye on services inflation. So there's concern about a number of factors. What's pushing services CPI higher? Wages, for one. And again, I go back to that big 0.8% jump in US wages and salaries for the month of February. Things like that, that's going to help feed more spending. More people are going to take, everyone's working, so everyone's making more of an income. So people are going to go out there and start traveling more, start seeing concerts. Yours truly, for example, is going to go see Def Leppard in August. So I'm one of those ones that perhaps will be contributing to higher services CPI. But that's one factor that's going to be contributing to sticky services inflation. Higher commodity prices is another, and that could add pressure for producers. We could get another shock, like something political, like another war, or a deepening attack in one of the current regions. Again, let's look at this past weekend as an example. That could set off potentially inflation expectations, and that could by itself be inflationary. We could get something, climate related, like another surprise from Mother Nature. Or at the same time, we could also get a premature rate cut. So I will think back to my long-winded answer, getting back to your question, by the way. I think that after, again, 525 basis points from the Fed, 475 from the Bank of Canada, 450 from the ECB, inflation has come down well down from those highs. But I guess the hardest part now is getting from 3 to 2. Because it's still very, very sticky, really, really sticky, especially in the US. So it's going to take some time, I think, before we hit 2% again.
You said another magic word, surely near and dear to the hearts of our clients. What does this mean for rates?
So rate cuts, I'm going to lean toward the rate cuts story. We are still expecting that to happen. The question is, of course, when. And that story, that whole theme, has changed a lot over the past, in the past week, I guess. How I was mentioning the whole factor of a premature rate cut, and this is what all central bankers want to avoid. Nobody wants to look, to use a eloquent term, no one wants us to look stupid by moving too soon. They need to be very confident that inflation is headed back to 2% on a sustained basis. And these are words, by the way, that are used on a regular basis by all central bankers, the fact that they have to be confident and seeing all this decline coming down on a sustained basis. So they need more data to prove that point, more than a few months, just to confirm that. They don't want to give up all these hard-earned gains of getting inflation down from like 8-9% down to like 3.5% that easily. And so this is all getting back down to credibility, I think. Again, no one wants to look silly by moving too soon, pulling the trigger too soon. Now, the ECB, I believe, is the only central bank that actually publicly mentioned it. I was going through their January minutes, for example, and that was one of the factors that they were talking about, that they do not want to move too quickly because their credibility will be at stake. So I believe it's just a matter of time before all the major central banks start to ease more readily. We just have to be very, very patient. We've got both Canada and the U.S. economy still, again, more resilient than others, but they are slowing. So some relief will have to come. They're probably going to say that rates are probably still are a little bit too high, and do we really need it to be that high? They just need, especially in the U.S., for inflation to cool. So right now, as it stands, for the Bank of Canada, we are looking for 3 rate cuts. Bank of Canada, 3 rate cuts this year. We're looking for rates to start falling in June, and then July, and then in December. So 3 rate cuts for the bank this year, 25 basis points each to about 75 basis points in total. Now, the Fed, we have been trimming our call. We are now looking for 2 cuts this year. Starting in July, that hasn't changed. We still look for that first cut to come in July. Then we're going to look for a little bit of a pause, and then they'll probably have them cut, and then they'll probably cut again after the November election. So 2 cuts this year, 25 beeps each, 50 basis points in total. Now, the risk has always been fewer cuts are starting later, and this is what we're seeing play out. And especially from the Fed, a lot of the Fed speakers, or almost all of the Fed speakers, have been saying very similar things. The Atlanta's Bostic has said he sees 1 cut in Q4. He also said recently that he could even see maybe 2 or maybe 0. So he's sort of being very careful with what he says. Fed Chair Powell basically said we have time, and Governor Waller said, "What's the rush?" So all these basically hold true. So I think that's more so the case now, that there isn't a huge rush, especially given the data that we have seen of late.
Mhm. Jennifer, what's been the story in terms of currency this year, and what's your outlook on currency?
I feel like, oh well, my goodness, on the currency market, I feel like it's been like the bane of my existence. And we just we just look at currencies from a year-end standpoint. So my colleague Stephen Gallo in the UK, our global FX strategist, he has to make the tough calls, like the 3, 6, 9 months calls. But overall, when you're looking at currencies, especially when you're looking at the US dollar, it's driven mainly by rate differentials. That's like the norm. But even though we expect the Fed to start cutting rates, and at that point, I believe that when the Fed starts cutting rates, you are going to start seeing the US dollar weaken. But nowadays, it's all sort of relative, right? It's like if everyone's cutting, which one's cutting faster, or if all economies are slowing, which ones are slowing at a slower pace, if that makes sense. So if we are correct and we continue to see the U.S. economy being resilient, slowing from 2.4% this year to just under 2% next year, that's still pretty strong compared to what we could be seeing elsewhere around the world. So I still think we are going to see a weaker U.S. dollar, but not as weak as it would be under normal circumstances, whatever normal is these days. And it certainly doesn't help, on the flip side, when we've got the yen hitting a 34-year low of 153 or so, or 154. That doesn't help because you've got the Bank of Japan who tightened rates, but at the same time watered down their actions by saying that rates will remain accommodative for some time, and they're still buying JGBs. So that's just an example that's not helping that side of the currency. But for the Canadian, so we look for the yen to strengthen at least to maybe about the 150 mark by the end of this year. The Canadian dollar maybe about 133, 134. Euro around 110. The pound around 128. The won will probably be still over 7, maybe 7.1. and the peso, for example, at around 16.75. So overall, still weaker US dollar, but not as weak as it could be.
Okay, thanks, Jennifer. We go back to thriving or surviving. If the opportunity favors the bold, but it's too soon to tell on rates, how are our clients on this call supposed to circle the square?
Oscar, my parents are really going to get their money's worth out of my high school education on this call today. It was Louis Pasteur who said, "Chance favors the prepared mind," and those who are surviving this cycle versus those who are thriving during this cycle, it's definitely the clients who have been prepared to take advantage of those opportunities when they present themselves. So Jennifer's talking about a lot about the macro environment and how there's shifting sentiments, changes coming in different parts of the world and in different components. But at the core of liquidity management, the core tenets have not changed, and the clients that are thriving have employed those core tenets in order to capture. So I talked earlier about the infrastructure. The infrastructure is the enabler of these opportunities, and the clients who have most confidence in their ability to forecast their cash flows have been the clients who have been thriving throughout this environment. So good forecasting on cash flows leads to the ability to plan very well the segmentation of your cash. So if you can understand thoroughly what is my core operating cash, what is my reserve cash, and then what is my strategic cash, it allows you to create buffers in between those tiers and take different tactics and employ different tactics on top of those buffers in order to capture additional yield opportunity. So the clients that have done the work to understand the cyclicality of their business, to understand how the macro environment has affected the way they operate, have been the ones who've been able to deploy these tactics and capture yield. And Oscar, you were a basketball player, so you know the adage, practice makes progress. Shooting the free throws, doing the dribbling drills, enables you to be better on game day. And it's the same thing with liquidity management. And, our clients have not had the opportunity to practice too much. If you think about it, since the financial crisis, rates were extraordinarily low for about 8 or 9 years, in that zero lower bound. They started to crawl out, in 2017 to get above 1%. They lasted that long till, December of 18, and then the Fed went on pause again. That's not much practice for, how to best manage your liquidity in these environments. So not a lot of opportunity for practice, but even when rates are low, companies that focus on their infrastructure are the ones that tend to thrive.
Okay. So talk to us about those clients that are prepared and who were prepared for this dynamic environment. Where have they been deploying their liquidity?
Yeah, so as rates have gone up, it's all about opportunity. How do I deploy this liquidity and capture the best opportunity? And quite honestly, most of the conversations we have, the first place clients look is in retiring debt. So if it's floating debt, the cost of that debt is going up with the market. And if there is a lot of liquidity in the system, and to be able to deploy excess liquidity to pay down that debt, that's been the number one place to go. The second has been M&A. So not large transformative acquisitions, but we're seeing a lot of activity, especially in the commercial market, with smaller tuck-in type acquisitions. The opportunity, there have been clients, there have been companies that have not necessarily been thriving in this environment, and they've barely been surviving. And we've seen the stronger, more prepared clients take advantage of that and use it to their advantage and make these acquisitions. In terms of layering yield opportunities into cash management, it's been employing different tactics. So taking advantage of tightening up those working capital buffers and employing that cash flow forecasting has allowed clients to shift, to make changes and layer in different strategies into the way they manage cash. So that's, transitioning from, checking accounts to savings accounts to term type opportunities, looking at bond markets, corporate bonds, and even equities sometimes. Some clients have been buying Taylor Swift tickets too, because I heard that's a real performing asset in this environment, Oscar.
I've heard Taylor Swift and I've heard Def Leppard. It all relates. So Jennifer, how should our guests think about things going forward?
So I'm going to take that one, Oscar.
Okay.
Going forward, as we listen to Jennifer, it's all about, kind of what's the macro environment going to give us, and we're kind of on a similar path that we've been, since the late, fall, winter of last year. We're at an inflection point. Rates are going to change. However, as I talked about earlier, the opportunities to pounce on have come in short bursts. So what we've been doing, and we love our clients. Nothing gives our team more joy than spending time with our clients and getting to their office and understanding what their needs and concerns are. So, we recommend meeting with us as much as possible. Our clients that are managing the most liquidity right now we're meeting with quarterly, because things are changing quarterly and they have to get a tremendous amount of information. They have to digest what has changed quarter over quarter in order to take advantage of those opportunities. And, maybe I'll leave you with this, Oscar. One of the things that I've noticed over the past 18 to 24 months is that, our clients will call us up on a quarterly basis and say, hey, what's BMO's latest forecast on, the markets? And every time I send a forecast or show up in their office with a new forecast, I always have to caveat, hey, this forecast, even though we printed it last week, it's probably wrong and it's extremely unreliable and you can't count on it. So sorry, Jennifer and everybody, all your colleagues, but it's been tough.
Peter, I'm glad you took that question because those sound like fighting words. Jennifer, how does that make you feel?
First of all, thanks a lot, Peter. Okay, so you know what? This is, again, like I said earlier, this is a very complicated world now. The economic landscape is very complicated, but now we've got this added layer of complication coming from the political side of the world. Now, I don't know if everyone's heard this factoid already, but 2024 is a huge year for voters. Over 50% of the global population will be casting their vote in at least one election this year. So that's huge, obviously, right? So most recently, in March, there was an election of Russia, and of course we know how that turned out. 6 more years. Slovakia just elected a Eurosceptic prime minister. So this is how things are going to make sort of an added twist, I think, on the political front. Got other big ones coming up. India's general elections are starting off this Friday and going until June 1st. And we've got the EU parliamentary elections in June, and the UK might have an election in the fall. Now, I'm going to say Europe is also very interesting right now because it sort of lacks strong leadership, and it sort of needs it now, especially with potentially strong forces coming into play in January of 2025. There's no more Angela Merkel anymore. So I don't know if you can rely on Scholz. Macron's time is limited in office. We're going to look at Italy's Meloni. We'll have to see how that goes. So it's going to be very interesting to watch in terms of the parliamentary elections. But I think of all of the elections that we were looking at this year, I like to call the bookends are the most politically charged. And of course, I'm thinking about Taiwan and the U.S. on November 5th. And just focusing on the U.S. elections, it makes me, quite frankly, very worried about what's going to come up in November when we have Joe Biden versus Donald Trump. So we could see from an economic standpoint the potential return of more trade wars, as both of them are trying to sort of out protectionist each other. They're both of them are protectionist, but they're trying to be more protectionist than the other. It seems, you've got the self-proclaimed tariff man out there who's actually, threatening to put a 10% tariff on all imports going into the U.S. And if they're imports from China, you're going to see a 60% tariff slapped on. And that obviously would mean very much higher prices, which means higher inflation and lower profits, and all that is not good news for the U.S. economy. Now, there's also a lot of policy uncertainty out there. We don't know what Mr. Trump's stance is, on climate change, on energy. We don't know what his views are for, how supportive he is for Ukraine or Taiwan, of NATO. But of course, when we're saying NATO, we know roughly what his views are. And he did say, let Russia do whatever the hell it wants to do to a country if it isn't paying up to be in NATO. And of course, we don't know what his stance is going to be or what he's going to do with the Federal Reserve, even though he did threaten to fire Fed Chair Powell. So all this is going to be very interesting, but maybe not in a good way because it introduces a lot of policy uncertainty. Now, the common denominator for both candidates is basically China, in terms of reining in trade from China, and of course, national security being a very key theme in what both of them are going to be talking about. So I should also mention that while everyone in the world is focusing on this upcoming election, I was reading about this thing called the anti-America axis, which is like China, Iran, and Russia. So almost like that group who's sort of waiting to act on a moment of weakness in the U.S. So all this, makes things, forecasting especially, very, very complicated.
Yeah. How about all those surprises, like what happened in Taiwan or in Baltimore most recently?
Yeah, so those are, for sure, we can't. Those are things like earthquakes and collapsing bridges, or is that something we can't predict or forecast, obviously. But these obviously have a big influence as well on inflation and in the economy. Remember the Ever Given, back I think it was 2021, that ship that kind of got jammed up in the Panama Canal, or that couldn't get out, so that would cause like a 2-week backup. But these sorts of things, an earthquake recently in the tri-state area, all these things are not forecastable. So we sort of have to put a little bit of buffer in there for things like this, I guess. But there's, how much buffer can you possibly have? But even things like climate change will also have are things that we can't predict, and that has caused a lot of volatility in food prices. A couple of things that come to mind, they're talking about recently, Quebec's strategic reserves of maple syrup are at a record low. So everybody has to hold off on how much maple syrup you're going to put on your pancakes or your waffles. Cocoa prices, going through the roof, and those of us I love my chocolate, so I'm going to be paying a little bit more for that as well. So all these things are also due to climate change, which is also putting upward pressure on food inflation. And I also want to mention one thing as well that we can't predict, but there's a lot of strike activity going on, especially we noticed a lot last year, but workers, again, going back to what I was talking about with the tight labor market, workers have a lot more power these days. There are a lot more stories about, when you're hearing stories about hoarding and shortages, that gives and that sort of empowers workers to make greater demands for more money, for fewer hours. And some of those demands, by the way, are being met in some countries, like Germany, for example. Their train drivers recently got what they were asking for, which is fewer work hours, 35 hours instead of 40. Some upcoming strikes, the UK train drivers, they're going on a rotating 3-day strikes. Recently, the UK equivalent of Stats Canada, or the BLS, it's called the Office of National Statistics, the ONS. These statisticians in the UK are striking because they have been told to return to the office 2 days a week. They're not liking that, so they are going to go on strike, which is going to be basically messing up a lot of the data that the Bank of England needs to make their monetary policy decisions. And then also, lastly, France's public sector workers are threatening to strike during the Olympics in Paris this summer. So unless all of these shortages that we keep hearing about or talking about are met by things like AI, or unless there's some sort of a baby boom in the next few years, which I don't think is going to happen, it basically means, again, that labor markets are going to remain tight, not as tight as it once was, but still fairly tight. And that is going to, I fear, potentially mean higher wage costs and higher inflation.
Yikes. I thought we were supposed to be telling our clients that everything is all rainbows. I guess that's not accurate.
No, unfortunately not.
Okay. All right.
Oscar, I'm still in shock over this maple syrup thing. I don't know what to say. Is that real, Jennifer?
It is. It is. Record low strategic reserves.
That's amazing. I wish I had more to add to that, Oscar. But when we think about the uncertainties and the changes in the market in the U.S., you have to remember, like it was a little over a year ago when we had two major banks fail in our market. Literally, one of them literally overnight. The other one, was a bit of a slower march towards closure, but a shocking situation. And this is, one of the things that we dealt with quite a bit last year, especially in the U.S. market. We were getting inbound phone calls from CFOs of our clients. Their board of directors were up in arms. One of the things our clients didn't have to think about, again, for 15, 16 years, is thinking about and understanding the counterparty risk of their financial institutions that they do business with. And luckily for our clients, our team was there to help walk them through what happened, how could this happen in this type of environment, what were the core drivers, but also help them. And this, again, goes back to the infrastructure of liquidity management. It goes back to Treasury and investment policy. We spent a lot of time with our clients rewriting their policies to factor in some of the elements that caused some of that uncertainty in the bank market. So whether that was, adding different metrics, in loan diversification or, ratings or, capital ratios and things like that. I mean, these are things that haven't had to be contemplated at all, that needed to be layered in. So again, corporates who were, finding ways to reduce their exposure to these, unforeseen risks is another theme we saw last year and something we're working with our clients on.
Okay, I see. So this goes back to being prepared, regardless of what type of environment we're in. I want to linger on the bank market in the U.S. a little bit. Have the concerns subsided, or is this something that our U.S. and Canadian clients are doing business in the U.S. still need to think about?
So, yeah, it's a good question. For the most part, the concerns have subsided. There was an orderly wind down of Silicon Valley Bank. First Republic was taken over by JP Morgan, and since then things have calmed down relatively. Now, earlier this year, in the first quarter, there was another bank on the East Coast of the U.S. that got into a little bit of trouble, and that was related to their exposure to the commercial real estate market. So one of the things still kind of hung over from COVID in the U.S. and Canada as well is getting folks back in the office. And this has a direct impact on the commercial real estate market. Occupancy rates are down. Our commercial real estate clients that are looking to refinance their assets, have to kind of deal with that challenging environment. So there is a little bit of uncertainty that remains, especially focused on that sector. So like Silicon Valley Bank, there's a lot of exposure to a specific industry. This bank out of New York earlier this year, same thing, a lot of exposure to a particular industry that's stumbling a little bit due to the rate environment. So, look, I think right for now, things are calm. If rates take their glide path that are expected, I think it should work itself out. However, if there's surprises, who knows? So again, understanding, the risk that you may carry with your banking partners is important and something to, make a factor when trying to navigate this environment. Thank goodness for us and you. BMO is as strong as it's ever been, as diversified as it's ever been. So you're operating in a good place.
Think about all those challenges that you just described. What have businesses been doing to react? Yeah,
so there has been a lot of bank rationalization going on, especially in the U.S. The environment in Canada is relatively simple. In the U.S., it's much more complex. You have to recall we have about 4,000 banks that are chartered with the Federal Reserve here in the States. So companies have been thinking about, it's not uncommon for especially larger companies to have many bank relationships, receivables here, payables there, club debt transactions and things like that. There's been a lot of rationalization of those relationships as a result of that turmoil in the bank market. So companies have been chasing stronger balance sheets, so consolidating their debt, consolidating their cash management with the banks that have stronger balance sheets. And typically in the US, that focus is around the regulatory environment. So the way that the Fed regulates banks is in buckets, and the most stringent, most arduous regulatory requirements are placed on banks that are north of $250 billion in total asset size. So we've seen clients consolidate towards banks that fit in that bucket. Of course, BMO does. The other thing we've seen on the cash management side is optimization around treasury management. So it goes back to forecasting. So to be able to run an efficient shop from a treasury perspective enables clean and better forecasting, which opens the door for the segmentation and the investing we talked about earlier. So we've seen a lot of automation on the back end, so integrations with banking providers, trying to get to the data that enables treasuries to become more efficient, to feed their cash flows and so on. So automation on the back end, integration, and then also, maybe finally, Oscar, we've seen clients migrate towards using technology to support that journey on the treasury side. Reconciliation becoming one of those elements that technology is really enabling to create more efficient back ends. So partnerships with our partner, Modern Treasury, the employment of virtual accounts have allowed clients to become more efficient in reconciliation. And again, it creates that feedback loop back to ability to forecast, ability to segment. Having a tight policy allows you to employ those tactics to take advantage of the yield environment that we're in today.
Yeah, thanks, Peter. I think back to the theme and the title of today's conversation, and it's thriving or surviving. And I think there's a couple of key takeaways for me after listening to Peter and Jennifer, and that is number one, as described, fortune favors the prepared. So for those that are thriving, it's being prepared for sometimes uncertain times. And also the importance of being nimble and adjusting to economic conditions to make sure that we can, like I said, adjust to accommodate what's going on in the environment. So I want to say thank you to Peter and also to Jennifer, and for each of you that joined us today. We take cues from our clients and the market to create content. In the next few days, you'll hear or receive an email from BMO with a link to a survey about the session, and also a letter about CTP credits. We'll also provide a link to this recording, and we encourage you to share it with your network. Thank you so much for joining us today.